If I can only choose one, I'm going with the stock market because it's the easiest to start off with. I don't need a whole bunch of money. And even if I do have a lot of money, there are still a lot of advantages for me to do that.
I'm trying to give me a bag. I'm trying to give me a bag. I'm trying to give me a bag. I'm trying to give me a bag.
What's up? You are now listening to FY Fly the podcast, and I'm your host, Hassan Thomas, along with Remy, and we are here to share tools on how millennials can budget, save, invest, and understand student debt and credit to achieve financial freedom. If you're a high school student, college student, or someone who's interested in gaining more financial insight, this podcast is for you.
I'm trying to give me a bag. I'm trying to give me a bag. I'm trying to give me a bag. I'm trying to...
What's up, my FY Fly folks out there? How y'all doing? I hope y'all doing all right. Welcome to the FY Fly podcast. My name is Hassan Thomas, aka the kid that did and the man that can, baby. And today, we're going to be chopping it up with investing expert, author, and fellow award-winning podcaster, Mr. Kevin Matthews, aka Mr. Building Bread. How are you, man? How's everything?
I'm doing good.
Yes, sir, man. I had the great opportunity to meet my man at FinCon. Man, how's everything been since, the conference, man?
Things have been good. Just, unwinding, kind of putting everything to practice that I learned, keeping in touch with everybody as well. But I had fun.
Yes, sir, man. Definitely had a great time at FinCon, but now we here on FY Fly, and what we like to do, we like to skip the fluff and get right into the good stuff, man. So, like I was telling you, I've been listening to you and your OG podcast host, Andre Albritton, since I graduated in 2020, and I love what y'all doing. So, big shout out to the Investing Flavor podcast. Big shout out.
Appreciate it.
But I want to start a conversation around, like, what made you who you are today? Like, were you always good with money, or was there like an event or something that happened in your life that made you like, okay, now it's time to get right?
Yeah, that's a good question. There are a few big events that happened in my life, and I would say the first one was this. So this was 7th grade, I think 2002, 2003. My parents was like, look, we're not buying you no more Game Boy video games, no more Pokemon cards, none of that. Like, you figure it out on your own. So I'm like, bro, y'all gonna cut me out?
They threw you off the porch in 7th grade? My Lord.
Bro, they did. They cut me out. They was like, you spending too much money on it. So the first money lesson I learned was they would give me like $5 a day for lunch. So I had the little time management plan that they give you in middle school, and I figured out, like, look, bro, that's like $10 a week, or what is that? Yeah, $25 a week. It's about $100 a month. Like, bro, if I game this right, if I spend $3 and keep $2, this money gonna add up. So that's actually what I started doing. So I knew, like, hey, spring break, I'm not gonna get paid that week. I need to figure out what I'm gonna do, and that's why I started budgeting and like long-term planning for my money. And that stuff like snowballed into investing, snowballed into financial advisory, and everything since then.
Man, that makes sense. And that actually brought a story into my head. So I was living in Texas at the time, and we were going to Orlando for Disney World. And man, I had a PSP at the time. I know y'all remember the PSP, the little portable joint PlayStation game.
I remember that.
And I had like a portable DVD player. So I had those two things. So what I did, bro, the train ride was 26 hours. So I literally budgeted my time of how many games and how long I'm going to be playing the games and how many movies and how long each movie was. I budgeted out 26 hours. So we definitely relate on, being young, and then also, really managing and being intentional with our time and our money.
Yeah.
Because those are the two most valuable assets.
Absolutely. When you learn it early, you start to figure out, like, this stuff carries well. Like, it's the exact same lesson, right? It's just you got more money, right? So definitely glad I learned that. I guess it was good that they cut me off back then. But yeah, that's a part of really what made me who I am today.
I love it, man. I love it. And for like everybody listening and watching, why do you think the best time to start investing and saving is now?
Yeah, I think the answer is always right now. And the biggest reason I say this all the time is because 10 years from now, you're going to wish you started 10 years ago. Everybody says, oh, I wish I bought Amazon back when it started. Oh, I wish I could go back and invest in Apple or whatever. Yeah. And people forget, like, those stocks, when they first started, they weren't good. Amazon started in like 97 or so when they were publicly traded, and then immediately fell in the dot-com bust between 99 and 2001. You would have to go through that. And anytime the market is low, this is usually one of the best times to invest. Everybody says buy low, sell high.
Come on now.
The market's low right now. Come on in. Come on
buy
with
them
it.
on discount.
Right? Yeah.
For sure, for sure. So I got a quick question on the recession because we're going through it now. The last 2 quarters have been negative, declining GDP. And I did actually before we got on, I saw. Do you follow a dude named Debt Free Joe on IG?
I think I do.
His name sound familiar.
Yeah, his name definitely sounds familiar.
Yeah, so I saw he does like a lot of reels where he's like showing his face and got the green screen of like Yahoo Finance or one major publication. He said I think it's like 70% of CEOs are preparing for a recession or major recession in the next 6 to 9 months. So I definitely wanted to get your thoughts and opinions on from your experience as a financial advisor and the couple of recessions that you've been through, how do you foresee this recession truly affecting, the everyday average person?
Yeah, this recession is going to be different. And I think that's the key thing. Not every recession goes back to like 2008 era.
Okay.
Even 2020 was a recession. It was just really quick. So, and they are always caused by different factors. What we do know is this. Right now, Americans have spent through about 30% of their COVID savings. So when we had COVID, we had stimulus checks. People just not buying gas, not buying a lot of stuff. So everybody just saved a lot of money, which in general was a good thing. But we just did find out that 30% of that money has already been spent. So that money that people were saving is helping to drive inflation. But once it runs out, that's when you're going to start to see a lot of things start to slow down. Again, just because it doesn't make it the worst thing ever, but you should start to see inflation come down a bit, but you're going to see spending slow down a bit too, and that's what's going to hurt a lot of these companies.
And so I'm working on my second book called From College to COVID to Recession. A guide to making and managing your money during the economic downfall. And I've been interviewing, economists. I've been interviewing some experts in, the real recession and economy field, not just strictly sticking on like personal finance experts. And that's something that they mentioned was that this will be a consumer-led recession.
Yep.
So that makes sense when you say that, we've had all that excess money from the stimulus, from the PPP loans that folks wasn't, some folks weren't supposed to get, what I'm saying?
Right.
So it makes sense when you say that. So when those funds end up drying out and then those businesses start cutting people, I do see what you're saying, that this recession will really, really impact people. But from your opinion, what can we do to start preparing now for this recession that we're in and, that may get even worse as time goes on?
Yeah, the biggest and best thing you can do is continue to save like actual cash, money that you can get to whenever you need it immediately without paying taxes, without paying a penalty, or without risk of loss. And the reason why you want to have that is because if something happens, if you lose a job, you don't want to have to sell your stock to survive, right? Because you're going to be selling at a loss, and that's, you take out, that could be a penalty if you're taking it out from a certain account. So having that cash is going to be the number one thing. I've continued to build my cash reserves, like just in case I'm going to be all right? But that's the number one thing you want to do. The other half of this too is people are starting to get paid a little bit more on their savings accounts, which does help. And also saving does prevent or at least slow down inflation. So please, everybody just save money and not spend so much of it. And that actually is going to help everything across the board.
Okay, makes sense. So would you advise high yield savings account? Would you advise putting some into like a brokerage for like short-term goals, or you just say stick for right now with an emergency fund in a high yield account?
Definitely a high yield savings right now for the purposes of recession. You definitely want to have in a high yield savings account.
Okay, that makes sense. So, I want to transition a little bit into your investing bag, man. I don't know if you watch I Am Athlete with Brandon Marshall.
Yep.
Yeah. So I want to get a little messy, man. Because this is a financial literacy show. So we interview entrepreneurs, real estate agents, a wide variety of people. So I saw some real estate folks trying to come for you, man, about that post that you made a couple weeks ago. So can you elaborate on why you chose to build your wealth through, or build your bread through stocks compared to real estate?
Yeah. So I'll say this: real estate isn't a bad thing. I think a lot of people are just like, he's just anti-real estate. Like,
let's clear the air.
Yeah, like I bought my first rental property at 19, like chill. So my thing is this though: the stock market is the easiest thing to get into. It's the most liquid and requires the least capital. So there are people like, I bought 2 investment properties. I'm doing this and that. I'm like, yeah, but you need $60,000 to start. Everybody don't have that. I can start with
now.
$6 and invest in Disney tomorrow, right? And I can start to build my cash up like that. The other thing too, especially for African Americans, our primary investment, what most people consider investment, is their primary home. Well, Black homes are devalued at about $48,000 per home. We pay, even with the exact same credit score, we pay higher interest rates for that. So I'm sitting around like, well, if I'm going into real estate and the real estate is being devalued, I'm paying more in fees, I'm paying more in interest. Why would I do that when I can make the exact same money as everybody else in Apple or Google or an index fund or literally anything else out there? The last thing I'll say on the real estate front is we saw what happened in 2008, and there have been tons of studies by now that showed that because African Americans were overly invested in real estate, we didn't recover at the same rate as everybody else because everybody else had stocks. So those are just the reasons. If I had to sell off, if I had an emergency, right, we're talking about a recession, I can't sell half the house and pay for something. I can sell half a share. Right, I can sell half my portfolio and use that and go and do whatever it is I need to do. So those are just some of those reasons. Again, you can do both. I think doing both is great if you can do it. But if I can only choose one, I'm going with the stock market because it's the easiest to start off with. I don't need a whole bunch of money, and even if I do have a lot of money, there are still a lot of advantages for me to do that.
Makes sense. Since we're on that stock wave right now, man, let's stick to it because you mentioned people with not a lot of money can start investing early and often. So can you tell us about like fractional shares and how that can really help, a lot of folks who don't have a big bag, start to accumulate that wealth?
Yeah. So a fractional share is a fraction of a share. So for example, let's say that Google stocks, shares of Google right now are $100. I'm just making up a price here. Well, if I don't have $100, I actually, back in the day, you can buy it. That was it. You ain't got $100, you can't buy none. However, today, let's say I got $5. Let's say I got $10. I can get 10% of that share. And if Google goes up 20%, so too does the 20% on my $10 grow. So the advantage is even if I have small amounts of money, $25 a week, $100 a month, you can still invest and still grow your money. You cannot do that in real estate with $15. You can't do it. And the thing is, I'm choosing small amounts, but like if you go back and look at the money you could have made in 2020, because I know this year is down, but in 2020, investing $100 a month in something like Tesla would have more than doubled that year. So like these small amounts do actually add up, especially if you're talking 10 or 15 years. So these small amounts add up. Obviously, you add a zero, it's going to be even better. But those fractional shares can be an absolute game changer.
Big facts, man. And I think that's so big for the young folks listening, the high schoolers, the college students, the recent grads, because there is a lot of things we want to do with our money, and that's okay. But if you know that, if you're being exposed to this financial literacy movement that, we've all been on and, promoting, then you know that investing early is the true key. Time is the biggest component to building wealth. So by us starting at an early age, even with, like we said, the fractional shares, that's going to be much better than waiting until we're 30, wait until we're 35 to then start investing because we're making a lot more money.
Absolutely. And I think the other thing that we don't talk about enough is a compounding of experience. Like you may start off at 20, 22, you may start off at 18, you make a mistake, but like I'd rather learn that mistake at 18, 19, 20 and learn from it than make a mistake at 45. It's costly. It's costly at 45, right? You like, I ain't got but so many years that I feel like working, right? So even if you start early, do that, make those mistakes and learn. Like for me, I started my business that I still run to this day, which is crazy to think about. In 2010, I was a kid. The first 5 years, I made $0. That was fine because I was still in college, just got my first job. It wasn't that big a deal. But like if I started a business and I got 2 kids at 35 and you ain't making no money, that's a stressful situation, right?
Big facts.
Like get out there early. If you're gonna make a mistake, you might as well make it early, make it cheap, and then continue to grow and get better from it.
Huge key that you pointed, and I'm following on the same wave that you did in 2010. I started my business in 2020 when I graduated. I wrote my first book from college to COVID, so that was about 5 lessons that I learned going from college to COVID to starting my podcast. And then I also included 19 lessons from each podcast guest that I interviewed. So saying this to say, by me starting early and, continue to be consistent, I was talking to my cousin about this the other day, it's longevity. So I'm going to be in a position to, for say, you know, something new happens with the metaverse. Not everybody's on the metaverse in like 2027. I'd be in a perfect position to transition to that because I've been doing it for, you know, 2027 for, you know, 7 years.
Yeah.
Compared to me starting at, you know, starting in 2026 and then popping up like, hey, I'm a new podcast guy, financial, you know what I'm saying?
Yeah. And that's absolutely true because that is literally my story. So when I started, you know, I'm a sophomore in college, anybody had no money, but I'm like doing presentations about investing, presentations about budgeting, doing all that stuff. So about year 5, 6, once we're out of school, people start getting real jobs and real money. They're like, well, who do I go to? Oh, I remember that guy from the dorm. Oh, this guy's been doing this for 5 or 6 years. Like, he definitely knows what he's doing at this point.
Got you.
And that's how I got my first clients. That's how I got my first speaking gigs and all that kind of stuff because of that longevity. Once you're out there in the world and you keep doing it, you keep getting better. Like, they may not notice the first 2 years, and that's fine. But that experience starts to build up. That presence starts to build up, and that's how you get noticed, and that's how you really build those funds. That compounding interest of experience is the exact same way your money works.
Come on, man. That's huge. Compounding interest in everything. Experience, money, time. So that makes sense, man. So from your experience working with stocks, do you trade stocks as well, or are you more just a long-term investor?
I'm definitely more of a long-term investor. I do trading every now and then. I would say about 5% of my money and my time is used on trading.
Okay, so how has, you know, the long-term approach worked for you compared to the trading? Because my thing is, and why I'm asking this is because a lot of my young folks, we skip the initial knowledge of just learning and doing long-term investing and the easy stuff, the index funds, the ETFs, and we go straight to the harder things or the things that take more skill, because I believe that trading is actual skill and then investing is more of knowledge based. So like, how has, you know, those two, since you do both, how have they, you know, worked out for you in your opinion?
Yeah, so I think I make a lot more money by long-term investing for a whole ton of reasons. One is just easier, part of it. But I like to think of it like I'm a sports guy, basketball and football, and I think that long-term investing is like, you know, you Russell Wilson on the goal line. Just run the ball. Just run it. Like, it's right there. Okay. And that's like, you got to do the easy things first before you try to like throw on the goal line or throw a Hail Mary. Like, trading's throwing a Hail Mary. You might get some, you might miss some depending on who you are. But like, take the easy money first. And the easy money is sitting there, buying good companies, buying an index fund, and let it roll. It's the absolute easiest thing to do. Then you can take a small amount and you can start to trade and see how you are at it. Some people are good. Most people are not. So you got to be careful. And the reason why is because there are all types of events that can throw a trade off, right? You can have the right company, buy at the right time, and then some news story comes out and that's it, you lost. And you have no control. No, and it's like, hey, that's the game. That's what you get for trading. So you got to be careful about what systems you have, when you're buying, what you're buying. It's just a lot of different factors to be aware of. Just like, again, you throwing a football from the 50-yard line, the wind matters, who you throw into, like, is it raining? Like, all these things matter. But when you're on the 1 yard line, it don't matter that much. You just punch it in to get the easy money.
And to that point where you used about trading, you know, if a company, something goes wrong, one of their earnings goes wrong, but it doesn't matter if you're a long-term investor because you know you're holding that for the long term.
Exactly. You can weather those storms a whole lot easier if you're holding something for 10 years. You're probably not even going to remember that one bad day. So you allow yourself more space, more time to make mistakes if there are any, and you let the market smooth out because 8 times out of 10, the market is going to be up. So why not go for that? We have studies that show that if you hold an investment for 1 year or less, you have like a 48% chance of the market being positive. That's 1 year or less. When you start to do 5 years or more, you're looking at a 98% chance of the market being up. So that tells me if I got 98% chance, I'm gonna take it. So I'm gonna hold for 5 years, right? As opposed to like, oh, let me get into getting that in and out of this within a week. Like, you know, the odds are not in your favor at that point.
That makes sense. So like, what advice would you give to someone who has the initial knowledge like we talked about but doesn't have the urgency to start investing now?
I would say on the urgency piece, you're not going to get this time back. at the end of the story, end of the day. You're not going to get this time back. You're probably not going to get this price back either.
Yeah.
I remember, back when Tesla fell to whatever point it was, like, hey, you might not get this opportunity very often for you to buy at the price that it's at if you think that company is extremely valuable. Like today, at the time we're recording, Microsoft hit a 52-week low, which means it has not been this low in an entire year. That may not happen in the next few weeks. That may not happen in the next few years. So if you're looking to buy and have that compounding interest, this is the time, because every day you wait, that's one day less that your money is not compounding, one day less that your money is not growing.
Facts. And one of the biggest things that I was excited to talk to you about was dollar cost averaging, because I believe that, without not even just young folks, we don't want to do work. We don't want to do a lot of work. So I think the biggest benefit of being exposed to this, game the knowledge that we have is, automated investing. So can you elaborate a little bit on the importance of dollar cost averaging whenever you're investing into these stocks?
Yeah, dollar cost averaging is basically adding the exact same amount of money to your investments on a regular basis. So every 2 weeks, I'm putting in $1,000. Every month, I'm putting in, on the first of the month, I'm putting in X amount. The beauty of that is, one, it keeps you consistent. It makes sure that you are continuously adding to your accounts. The other thing too is it gets you out of trying to time the market, because it is difficult to say, this is the bottom. This is the absolute perfect time for me to get into the stock or into any investment. And then from here on out, everything's going to be fine. Dollar cost averaging says, look, whether it's the right time or the wrong time, you are going to consistently invest, and you're going to hit that point by default. Okay,
that makes sense. And for everybody listening, this is the way to do it. Let's not put, too much time and energy into something that we don't have to. If all we have to do is learn the initial knowledge and then set up an investing account and set up automated payments, for, 50, 100, 200, whatever you can do consistently, why not? And I think it's the people don't want to do the initial work, but what do you think can get them to that level?
Yeah, I think it's not just that people don't want to do the initial work. I think sometimes they're intimidated by it, because if you don't know, just like I was in 2010, took my first internship in New York. I'm like, I don't know what charts these are. I don't know what terms, what is all of this stuff? So I think the key thing is you don't have to be an expert to start. And I think that is the absolute key. If you just open an account, put in money and buy an index fund, if that's all you did, you good. Facts. And you can start to learn after the fact. But I think that's the most important thing, is just get in, get the basics. And then if you want to learn more, definitely go out and learn more. I think a lot of people try to sit back and let me read every single book and do every single thing so I feel like an expert. You're not going to feel like that. There are times where I don't feel like an expert because there's something new that comes out. Right. When I started this, cryptocurrency was not a thing. When I started this, NFTs were not a thing. Every 2 years, it's something brand new I got to learn. So the key is get the basics, start there. If you want to learn more, then do that as you go.
So a question jumped in my head while you were talking. A really big conversation, as you know, in the financial literacy community is, should we be investing and paying down debt at the same time, or should we focus on eliminating high interest debt and then investing? So from your opinion and from your expertise, what's your thoughts on that?
A part of it depends on how much debt, how long it would take you to pay off if that's all you did. I think that's a big question. But the main thing is, I would say maybe 85% of the time, do both, because while paying off debt is important and it's something we should all strive for, let's say that debt's going to take you 2 or 3 years to pay off. Well, that's 3 years that you are still not compounding. That's 3 years that you are not going to get back to invest. If I didn't invest, let's say in 2020, right, I would 2020, 2021, and most of this year, those are years I'm not going to get back. I cannot go back and invest at that exact same price ever again. So the key here is, do both if you can. I would say, let's say if you only had 3 months of debt, if you just focused and knocked it down in 3 months, okay, that's fine. That you can take. But when we're talking about a year or more, you definitely want to try to do both. And you can say, look, let's say just 100%, maybe I'm doing 20% to investing and 80% to debt. Whatever it is, you do want to get your foot in the door. You do want to start compounding that wealth so that you don't become debt free and broke. That's the thing, where you have zero debt, but you have zero investments either. And you're just I'm just at zero. It's okay, cool. But like, you could have been, positive 50 or whatever it's going to be.
No, that's a great key. That's a great key there, because I feel like with that, with Dave Ramsey's method of, eliminating all your debt, you are missing out on that time, on that compounding interest that we've stressed on here. So I think that's critical, man. And I want to ask you, so this is FY Fly, man, a show about financial literacy, which is not only understanding how to budget your money, but being able to save and grow your money effectively and efficiently. So my audience wants to know some good money habits that you have. And also, if you have any bad money habits, let us know so we could cut them off, man.
Oh, man. So I'm going to start with the bad money habit. If you can consider it bad, I don't necessarily consider it bad. But like, I be buying tacos, man. Look, every Friday, I go to
you're a foodie, man?
Yes, man. They know my name. They know everything about me at this taco. So maybe that's the bad habit, because, inflation, them taco prices ain't what they used to be. So
yeah, come on now.
I could definitely save a few $100s if I didn't do that as often. But I would say a good money habit that I do have, and one of the ones I'm most proud of, is for my business income, I set aside 5% to pay myself a quarterly bonus. And I set the money aside and I absolutely blow it on the most ridiculous things. So like, for example, I'm going to see Tom Brady and the Buccaneers play the Panthers in October. And that was hey, yeah, I was looking around like, hey, it's a few $1,000s in here that I get to blow. I earned it. I saved it.
Come on,
I'm just doing something random. So I get to do that. I bought a trumpet one year and started to learn how to play that. I was just like, hey,
passion project on the side, yeah.
Yeah. I was like, get to learn, do something new, and blow the cash and enjoy it. And I think that's something that we should all have, whether it's 5%, 2%, whatever percentage you want to do. Definitely set some money aside for you to actually enjoy, because having that discipline should have a reward.
Man, I think that's the first time anybody's ever answered that like that. And that is huge, because I always say that, money is a tool that we can use to live our best life, to make sure that we're safe. And a budget truly isn't a life restrictor.
Right.
A budget is just a life enabler, and it enables you to do the things that you want while you're still being responsible, still paying bills, and, have some money left over at the end of the month. So I think that's huge that you even, put it that way, because a lot of us, we're just spending willy-nilly, and, we don't have. Can you explain a little bit on how you particularly, budget your money? Like, is it for as like, do you track your expenses like boom, boom, boom every single day, or like, how do you kind of work from that budget?
Yeah. So I have my business budget, and then I have like my personal budget. So my personal budget, I try to adhere to the 50-30-20 rule as best I can. That's 50% of my money goes to expenses, 30% is for me to enjoy, and that 20% is split between my savings and investments. When my first job out of college, I was like, look, how do I get my rent to fit under that 50% plus all my other bills? And when I did that, and the first time it was like, 68%, it wasn't perfect, but the goal is to get as close as you can. But when you do that, especially if you're backing in your rent or your mortgage into that number, then it makes it easier to say, look, I've got 15% extra to save and invest and do all those things. When you go into it blind without looking at all that stuff, it makes it a lot more difficult to carve out those extra areas.
Okay, that's good advice for the folks listening, man. And I have one final question for you. I'm going to read you 2 quotes, and I need you to tell me which one is more accurate in your opinion, all right?
All right.
All right, bet. So the first quote is, more money, more problems, like Biggie. And the second quote is, money can't buy happiness. Which one do you believe is more accurate?
Oh, man.
So that's what you got to think about, huh?
Yes, it's got to be more money, more problems. It's got to be the one I got to agree with.
Oh, wow. Why is that?
Because money absolutely buys happiness. Like, it buys tacos make me happy.
Come on now, simple as that.
Simple as that. It's not going to solve every single problem in life. But like, the things I like to do usually cost money. If I want to go to the movies, if I want to go travel, if I want to eat amazing food, all that stuff costs money. So to me, it buys happiness to a great degree. In terms of more money, more problems, that can definitely occur. Like, mess up on your taxes one time and you're going to find it the hard way.
Yeah.
When you get a letter from the IRS, like, hey, you owe some money. I definitely got to agree with the more money, more problem statement.
Okay. So I was interviewing a guest, and I liked the way that he framed it. He said more money, more responsibilities. Not necessarily problems, but it's definitely more responsibilities when you do have that bigger bag. Would you agree with that?
Yeah, I definitely agree with that.
I can definitely see that, man. So thank you so much for joining the FY Fly Pack. Thank you so much for joining the FY Fly podcast, man. If you have any final words, any final gems you want to leave them with, go ahead and also let them know where they can reach you.
Yeah, you can reach me all things social media at Building Bread, YouTube, TikTok, Instagram. I think I said YouTube, Twitter, all those places you can find me on. And my thing is for y'all, just stay patient, stay the course, and make sure that you have a plan.
Come on, man. That's $1 million worth of gain right there, baby. So thank y'all for everybody listening. Make sure that you're not only just listening, but you're actually applying and implementing some of these gems that you've heard here today. Because even though everything may not have been for you, if you do catch those 1 or 2 things that you can actually run with right after this podcast, that's a win. So thank you again, man. And everybody listen, I need y'all to stay safe, stay invested, and stay FY Fly. We'll see y'all next week.
Thank you all for listening to FY Fly, the podcast, and we hope you enjoyed the show. Tune in next week for more financial literacy insights with our special guests. Please visit our website, social media platforms, and subscribe to our YouTube channel at FYI Fly Podcast. That's FYI FLI Podcast. See y'all next week and stay fly.